Good afternoon, everyone. My name is Chinoye Moses, and I am your host for today's webinar. I'll just ask that we hold on 5 minutes to allow more participants join us for today's enlightening webinar. Then we would start fully. Thank you so much for attending. Good afternoon, everyone. My name is Chinoye Moses, and I am your host for today's event. And I'll just ask that we wait 4 minutes and then we would start today's webinar fully. Thank you so much for joining us. All right. Good afternoon once again, ladies and gentlemen, our esteemed guests and fellow investors. So welcome to our webinar titled Investing in Gold, diversification beyond traditional asset classes. I'm delighted to have you all join us today for this insightful discussion on diversifying your investment portfolio with a focus on gold and other asset classes. As we navigate the ever-changing landscape of financial markets, it becomes increasingly crucial to explore alternative avenues for wealth preservation and growth. Today, we have the privilege of hearing from three distinguished speakers who will shed light on various asset classes and their performance relative to the precious metal gold. Our first speaker today is Rachel Dixon, a precious metals trading officer at Dukia Gold. Rachel will talk about low-risk assets and will provide valuable insight on how these investments compare to the reliability of gold. And following Rachel's presentation, we'll have Habibla Aminullah, who will talk about medium risk asset classes and will help us understand the potential rewards and challenges associated with these investments. And lastly, we'll hear from Peter Anirobi, who will talk about high risk asset classes, and he will talk about the adventurous side of investing and how it stacks up against the security of gold. Each of our speakers will compare the performance of their respective asset classes to that of gold, giving you a comprehensive view of the investment landscape. After their presentations, we will open the floor for a question and answer session, allowing you to engage directly with our experts. Now, this is our disclaimer, safe harbor statement, non-disclosure, non-circumvention, and copyright. In the course of today's presentation, we'll be making some forward-looking statements, and we are not financial advisors. So we would also advise to also tell you that in the course of today's conversation, you should also seek advice from your financial advisors as well. Now, this is the flow of our presentation today. We're going to talk about all the asset classes, and we're going to talk about diversifying one's portfolio, and then we're going to go on from there. Now, without further ado, let's begin this journey into diversification beyond traditional asset classes. Please join me in welcoming our first speaker, Rachel Dixon. Rachel, the floor is yours.
Hello, Noye. Please confirm if you can hear me.
Yes, we can hear you.
All right. So thank you once again, everyone, for joining us. Thank you for our wonderful participants for joining us, for taking the time to join us today. My name is Rachel Dixon, and I will briefly talk to us about the low-risk asset classes. So moving on to the first slide. I will just briefly talk about low-risk asset classes. And this type of classes, they are investment options that are generally considered to have a lower level of risk compared to more volatile or speculative investments. These asset classes are often favored by conservative investors who prefer to preserve their capital, and they are willing to accept a potentially lower returns in exchange for a greater degree of safety. So there are asset classes that have lower level of risk compared to more volatile and speculative investments. They preserve your capital while they also limit your returns. Now, a couple of examples of these classes will involve cash and cash equivalents. This could be T-bills. This will be money market funds. They are highly liquid, but they have a minimal risk of loss of principal. We also have the bonds, government bonds, for example. And these bonds, they are like entity, they are issued by stable entities, whether higher level corporations, and people receive regular interest payments and a return of principal at certain maturity. So moving on to the next slide. It's just a simple graph of what it is, gold versus fixed deposit returns in the USD. And if you look according to the graph now, an ounce of gold that was bought in 1999 for 278 US dollars will be worth $1947 today, which represents a 600% return, while a fixed deposit of USD of 278.86 will have a real worth of $481.92, which represents a 73% return. This is just to let you know that in USD, gold is performing way better than fixed deposits, even in the US. And the next slide is just the same thing, but it's just talking about gold versus Naira. Moving on to the next slide. So it just says gold return in Naira versus Nigerian's fixed deposit return. And if you look at the graph now, or the chart, you see that gold does way better. An ounce of gold that was bought in 1999 for 6,000 will be worth 1.7 today, which represents a 29,000% return. While a fixed deposit of 6,134 will have a real worth of 4,593 Naira, which represents a minus 25% net loss. It shows that fixed deposits actually does not preserve your wealth or your income, and gold stands a higher chance. And we move on to our next slide, gold versus the Nigeria's 10 years government bond. Now, according to the slides, this is the return of an average yield percent for 10 years bond. This is the Nigerian 10 years government bond. And you see that gold's performance, although a little bit shaky, gold has been performing way better than the Nigerian's 10-year government bonds. The 10-year bonds have had this sort of relatively stable fixed return over the years from 2013 to 2023, but gold has outperformed it way better than most of all this. Moving on to our next slide, we talk about Sukuk bonds versus gold. And we talk about this, yes. So let me give a brief introduction on what Sukuk bonds are. Now, these are investment certificates that represent ownership interest of the holder in an asset or a pool of assets. It means this certificate, a holder is entitled to receive income from the use of a particular asset that is being used. It could have been used in a project or so. And now there are various differences between these bonds and gold itself. These Sukuk bonds offer a fixed return. And for 2022, the return per year is 15.64% per annum. But for gold, gold offers a variable return. Just the first half of 2023, gold had a return of 78.4%, just the first half of 2023, which speaks volume. For Sukuk bonds, there's a minimum subscription of 10,000 Naira. But for gold, you can invest as low as 5,000 Naira. For the Sukuk bonds, they are often used to raise capital for large-scale projects like road constructions and them. But gold is typically known as a store of value. It's famously known as a hedge against inflation and a safe haven asset during times of economic uncertainties. So this just shows that gold is doing relatively better than even the low-risk asset classes today. So that is all I will be talking about for the low risk level asset classes. And my colleague Habibla will take on starting from now. Over to you, Habib.
Thank you very much, Rachel, for that beautiful presentation on the performance of gold compared to the low risk asset classes. As mentioned, I am Habibla Aminullah, everyone. Good afternoon once again, and I'll be taking you through the performance of gold, being a good portfolio diversifier with the medium risk level asset class. Basically, which is my major focus will be stock investment. So stock investment is investing in stocks involves buying shares of publicly traded companies. The performance of stocks can be influenced by various factors such as company earnings, market conditions, and investor sentiment. Likewise, when we're talking about gold investments, basically we're saying we know that gold has been a popular investment option for centuries. It is often considered a safe haven asset and a hedge against inflation. Gold's value tends to rise along with inflation, making it an attractive choice for preserving wealth. All these are things that my colleague mentioned earlier. So if you look at this, the chart provided to you on this slide here, showing the performance of gold compared to stocks, basically the Dow Jones and S&P 500 US-based stocks, you see that in terms of risk, the volatility, comparing gold to that of stocks, gold is generally considered a lower volatility asset compared to stocks. Its prices tend to be more stable over shorter periods, as evident there on the graph provided. In terms, stocks, on the other hand, can exhibit higher volatility due to market fluctuations, economic data, including the company's performances. In terms of returns, from this graph provided, we see that both stocks having your money saved in investing in stocks or investing in gold, you can have long-term growth. Historically, gold has shown the potential for long-term price appreciation, although a more modest rate compared to stocks. It tends to retain its value over time, making it a store of your wealth. Stocks, on the other hand, have the potential for significant long-term growth, as I mentioned earlier. Over extended periods, well-chosen stocks can deliver substantial capital appreciation. Also, one of the major things we're actually talking about today is diversification. So investing in gold, including gold into your portfolio, creates diversification benefits for you, because adding gold to your portfolio can provide diversification benefits, as it may perform differently than stocks, as evidenced in the graph. During stock market downturns, gold can act as a hedge, potentially mitigating losses. Moving on to the next slide. Bringing back to our local markets, basically the NSE stands for Nigerian Stock Exchange. So in 2002, if you invest your money in stocks, the nominal return you'll be getting was pegged at 19.98%, and based on the published inflation rate, Nigerian inflation rate as at June 2023, which was 24.08. If you calculate your real interest rates, you actually be having a real interest, a loss of minus 4.10%. If you compare these with that of the return of gold, as mentioned by my colleague earlier on, just between January 2023 of this year, so June 2023, gold returned 78.04%. Calculating your real interest rate from this by subtracting your nominal interest rate from the inflation rate, you get a positive return of 53.96%. Moving on, this is why you need to include gold as into your portfolio to diversify your portfolio, because if you invest your money in stocks alone, you actually get your return. As we've established that there's long-term growth in investing your money in stocks. Investing your money in gold alone also give you a higher return, as we've established. But due to economic uncertainties, due to inflation, due to times of economic downturns, gold having a low correlation with stocks would help you balance your portfolio. If you add gold, if you invest your money in both stocks and gold, the benefit of combining both assets, like I mentioned, you have diversified risk. By combining gold and stocks, investors can spread risk across different asset classes, reducing the impact of a downturn in any single area of the portfolio. You will also have portfolio stability. Good stability can act as a buffer during times of market turbulence, helping to maintain portfolio stability. Exactly. Of course, you also have long-term growth and wealth preservation. To continue with this discussion will be a colleague of mine, Mr. Peter Nairobi, who will be taking you through the performance of gold compared to the high-risk asset class. Over to you, Mr. Peter.
Thank you so much, Mr. Habib. I'm Mr. Peter, and I'm going to talk about high-risk investments. I know a lot of us have investments in crypto, and crypto is the in thing now. So we're going to basically base our discussion today on cryptocurrency in terms of our high risk investment. Now, looking at cryptocurrency, we'll notice that there are some characteristics that cryptocurrencies have that are different from what gold has. What are these characteristics? First of all, we have to understand the fact that gold is a physical asset. It can come in form of coins, bars, or jewelries. Why digital currencies why cryptocurrency is just a digital currency that is stored in digital wallets. Cryptocurrency started in 2009 with Bitcoin. So it's a quite recent asset that just sprung up. But gold has been with us from time immemorial. In fact, gold has been a legal tender back in the days. So gold has a proven history of reliability as an asset. So apart from all these advantages of gold, gold also has other physical use in the sense that gold, apart from investment, gold can be used as a jewelry, it can be used in electronics, and it can also be used in dentistry, like the golden tooth that our artists and those who have been to Saudi Arabia wear. But for things like cryptocurrency, it primarily used as a digital currency and is used as a speculative investment asset. Now, gold bullion is highly regulated. You cannot just wake up one morning and start trading gold bullion. You have to pass through some standards, and that is what regulates this market. But crypto is a market that is fairly unregulated. So a lot of things can happen in this market which can make it move against you or move in your favor. But let's say more about the risk associated with cryptocurrency. First of all, I want us to look at this chart. Next slide, please. So looking at this chart, you will notice that I'm taking Bitcoin as a cryptocurrency. If there was a certain time it had a return of over 500%, and then it fell to about 89.16%. And if you look at gold, you notice that gold returns are fairly stable relative to Bitcoin. Now, we always say that with high risk come high reward, but this can come with high losses. Imagine if you had entered the Bitcoin market when it was at 500% return, and then it fell to what it is right now. You would have lost a lot of money. So a market like this is going to provide high risk, high reward, and at the same time, high loss. Talking about the volatility of cryptocurrencies, this next slide speaks to the volatility of cryptocurrency. Now, you notice that from this slide, gold is fairly stable. What this slide is telling you is when you take the price of each of these items, let's say you take the price of gold or you take the price of Bitcoin. So what range does it move upward or downward from those prices? You notice that gold is fairly stable. So if you put your money in gold, your money will not really lose its value so quickly. Unlike in Bitcoin, whereby if you put your money in Bitcoin and you entered at the wrong time or the market moves against you, this has a capacity of wiping out your full capital. And that is one of the major risks that is involved in trading cryptocurrency. Another thing I want you to notice here is gold has shown in this graph that it has a very low correlation to Bitcoin. And this is very important for us to pinpoint because is this low correlation of gold now make it a perfect asset to use and hedge your investment in Bitcoin. But these other market risks are not just the main thing that is available in cryptocurrency. There's also another major risk, which the next slide speaks about. This risk is what we call the counterparty risk. Gold has no counterparty risk. What I mean by this counterparty risk is once you have your gold, you don't need the approval of somebody else before you can do whatever you want with your gold. You don't need somebody to come and tell you that, okay, before you can move your money, you have to take this approval or not. But in cryptocurrency, there is counterparty risk. What does this expose you to? It exposes you to the risk whereby if any of these providers of your coin folds up, your money is gone. And this is similar to what we experienced in 2022 when big companies like FTX, we have the Terra Luna, the USD, Terra USD, all these were Bitcoins, all these were coins and cryptocurrencies that were big in the beginning of 2022, and they all collapsed. And what happened to the funds? It all went down the drain. So this kind of risk is available, is what you expose yourself when you trade in cryptocurrency. So please, if you have any question, please just drop it at the chat box. We're going to attend to it at the end of the slide. So in order for you to safeguard yourself against this risk that I've talked about, that is where the word diversification comes in, which is the next slide. Now, diversification simply means spreading your risk. Imagine the man who carries all his eggs in one basket. A simple trick is going to lead to the collapse of all his assets. But a wise man is that man who is going to spread his eggs across different baskets, so that if one should have an issue, he will still have the ones in the other baskets to fall back to. And that is where gold is very important, because gold is slowly correlated to cryptocurrency and is fairly stable. It serves as the perfect asset in which, even though you're doing your business, you're taking a lot of risk in crypto and you're making high returns, but gold serves as that asset whereby you can keep 25% or so of your investment, so that if anything should happen to your funds in cryptocurrency, your gold investment is there to hedge you against total collapse. So to buttress more on this diversification and balancing your portfolio, an expert is going to treat that, and I'm going to call on Nonye, who is going to discuss further on diversification of your portfolio. So over to you, Nonye.
All right, thank you so much, Peter. Now that we have heard from our esteemed speakers, we've heard from Rachel, we've heard from Habib, and we've also heard from Peter. Now that we've heard from them about the various investment options and their comparison to gold, it's also important and essential that we tie all these insights together. So now, diversifying your portfolio is not just about spreading your investments, but it's also a strategic approach to managing your risk and also maximizing your potential. Now, diversification not only spreads risk, but also opens the door to a broader range of opportunities. And it's about finding the right balance between your risk and reward, and also aligning your investment with your financial goals and adapting to the changing market conditions. Now, in today's world of uncertainties, diversification is not just a strategy, it is a necessity. It helps to protect your investment from unforeseen shocks and also can lead to more consistent returns over the long term. As we have seen today, different asset classes offer unique advantages and drawbacks, and finding the right mix is key to a resilient investment strategy. Now, let's simplify all of this. Imagine you have some money to invest. It's important to understand why it is smart to spread your money around instead of putting it in one place. Diversifying means not putting all your eggs in one basket. Now, just like a smart farmer would grow different plants to protect against bad weather, a wise investor spreads their money across different things like stocks, bonds, cryptocurrencies, and more. And this helps keep your money safe when financial markets get bumpy. Now, diversifying isn't just about safety. It's about making more money as well. Now, different investments do well at different times. For example, when the economy is doing great, stocks can be a good choice. But when things aren't going well, bonds might be safer. Now, real estate can protect your money from rising prices, and precious metals like gold that we're talking about today can be valuable when things are uncertain, just like we're experiencing these times. So diversifying is like having a map to navigate the ups and downs of the economy. But diversification isn't just about picking different types of investments. It is also about spreading your money in different places and industries. This way, you can find good opportunities and not rely too much on just one thing. In today's world, where many things affect the financial market, diversification is crucial. It helps you stay safe when things change so you don't put all your money at risk. In the end, diversifying your investment isn't just a good idea, it is a strategy for success. It allows you to take full advantage of the world's financial opportunities while keeping your money safe and also growing. So remember, diversification is like your financial compass, leading you to financial security and long-lasting prosperity as you navigate the world of investment. And that's where we at Dukia Gold come in. We come in, these are our products. We have deliverable gold bars and coins of the highest purity in varying sizes and weights. Weights range from as low as 1 gram to as high as 1 kilogram for bars, and in ounces and fractions of ounces for coins. And we also offer a third-party secure and insured storage and delivery. We also have the managed gold products. We have the pool allocated gold that allows investors to invest in vaulted gold based on monetary value from as low as 5,000 naira. So this debunks the rumor or the news that you have to have so much money before you can start investing in gold. With Dukia Gold, with as low as 5,000 naira, you can start your investment journey in gold. And then we're also talking about how many percentage of my savings should I put in gold to balance my portfolio. 20 to 25% of your savings will offer you, once you put that in, you expand your portfolio, you have your portfolio, you invest 25% of it in gold, it opens your way to a balanced portfolio. Now, how do we get started? We're not just going to talk about the product. We also need to tell you how to get started. How do you get started? You just get started by visiting our website, dukiapreciousmetals.co. dukiapreciousmetals.co. Once you visit our website, you click on Get Started, you fill in your necessary details, and you create your account. So when you log into your account, you also have to confirm your email address. And when you log in, you'll be presented with a KYC form. That KYC form, you can't do anything on your account until you have completely filled your KYC form and it has been verified. And once you have been verified, your journey starts. You can now proceed to fund your account, and then you can go on to purchase gold. Now, in conclusion, we have seen that there is need to diversify our portfolio, your portfolio, and you need to diversify your portfolio with assets that are not correlated. And gold has proven to be the least correlated asset among all traditional asset classes. Now, thank you so much for listening. At this juncture, I will ask that if you have any questions, please put them in the chat box. Now we're in our question and answer session, and we'll have answers and we'll address your concerns and answer your questions. Thank you. All right, so now for our question and answer session, I have a question here from Oluwaseye Ayodele, and it reads, I appreciate the lectures. They are very motivating. How can I invest in gold? How do I go about it, digitally or physically? Mr. Peter?
Thank you so much, Oluwaseye. I believe Noya has done a lot of justice to that. So you can invest in gold by visiting our website, You check out the products that we have. We have different products. We have from discrete gold products to pool allocated goods, managed good products as well. So you can go through our website and then kickstart your investments in gold. So that is one way to go about it. I believe the link to the website is on the chat box, so you can check it out and go about it. So looking at the second question from Joel George. Yes, I saw your question. You said according to the volatility chart of gold versus Bitcoin, as an investor, investing in gold, according to that chart, shows that even in a very long time, the value I receive as the investor isn't really seen compared to that of Bitcoin, regardless of the risk of the signals. Except I got it wrong. My question is according to the volatility chart, how does or when does the investor see his profit when investing in gold? And speaking as someone who's already used to seeing his profit from crypto in a short period of time. Okay, yes. So that is what I was talking about when I was speaking about high risk, high reward, and also that exposes you to high profits and maybe high losses. So that is what happens in that scenario. The thing is, gold investment is actually a long-term investment. It's not something that you invest today and maybe you get a profit tomorrow, because it doesn't fluctuate. It's not as volatile as cryptocurrency. But the key thing that we are trying to pass here is the fact that gold investment, when you're making investments, you should try to diversify your portfolio. Now, first of all, you already have investments in cryptocurrency. It will be wise for you to safeguard. Don't put 100% of your money in cryptocurrency. Have your investment across other portfolios. Now, you can have your investment in crypto. Let's say you say you have investment in Bitcoin. Bitcoin can move against the market, just like the chart showed. In the chart, you can see that in 2001, Bitcoin had a pump, and it had a pump because during the COVID-19 pandemic, there was this fear there was this recession that took place, and investors noticed that Bitcoin and gold as well were not moving in the same direction as stocks, bonds were moving, and a lot of investments were done in Bitcoin. And Bitcoin went as high as 60 something thousand, I think got up to $68,000 for one Bitcoin. But after that, it's currently at about $26,000 for a Bitcoin. Now imagine somebody who entered Bitcoin market at 68,000. The person would have taken a huge loss. And that is just the long period of it. The same thing, someone would have also made a good profit. But the key thing here is try to spread your tentacles. Have investment in Bitcoin, have investment in other asset classes. But the key thing there is investment in gold. And that is where the chart that the other speakers showed, if you can just take it back to the chart of gold versus USD, you will notice that gold returns outweighs the return you're going to get. For example, okay, this is it here. Now, let's assume that you have $100,000 and you decide that, okay, I'm not going to invest the whole $100,000 in Bitcoin. I want to keep $25 in an asset that is secure, just in case the market goes against me. We pray it doesn't, but you have to be ready for tomorrow. Where do you keep that $25,000? That is the question you now have. Now, if you decide to leave that $25,000, which is your fallback in case of rainy days, fallback fund, in something like a fixed deposit in US dollars, because I know you might not want to keep your money in Naira, but let's say you keep it in US dollars and you put it in a US dollars fund that gives you a return on investment. Normally, it's usually around 4 to 5% per annum that domiciliary investments offer if it's a fixed deposit. Now, over the years, look at it from 1999 to 2023, you see that the return on gold has always outweighed the return on leaving your money in USD cash. And the same thing happens to other safe investment that you can put your money in. If you decide to put it in bonds or treasury bills, gold outperformed it. Gold has more returns than it. If you decide to put your money in safe stock, because there are stocks that are also high risk. If you decide to put it in stocks like S&P 500, Dow Jones, and the rest, you'll notice that gold has also outperformed those stocks. So in terms of keeping part of those money in a safe investment, gold shows that it has outperformed all other investment classes that are seen as safe, that you can keep that your rainy day money. So that is the key thing about investing in crypto and investing in gold. So Nonya, you can write on.
All right, thank you so much, Mr. Peter. Now, the next question says, good afternoon, speakers. Can you please estimate the worst or average return on investment to someone like me that doesn't know anything about gold yet, but would like to start investing in it? Mr. Peter, please can you address this?
Okay, thank you so much, Nonya. Mr. Owolabi, okay. Okay, the thing there is gold historically, okay, has been positive. That is one key thing that is there. If you take the returns that gold has had from 1999 to today, you notice that on the average, though the thing is that gold returns is also an investment as well. There are times it returns negative and there are times it returns positive. But the average, you see that it has returned on the average over that period in Naira form, an average of about 33% returns every year. That is the average that gold has been returning in Naira format. So you see that on the average, it's a good investment, because the key thing that you have to take note of is it above inflation? Because if it's returning, if it's having a return that is below inflation, it's telling you that your money is actually losing value without you knowing it. So gold return has always, on the average, been above the inflation rate of Nigeria, meaning that it's the perfect investment you can do with regards to safeguarding your wealth. Any other investment you do in Naira, like keeping your money in a fixed deposit now, I think the best you can get for fixed deposit is about 20% per annum, and our inflation rate today is over 25%. If you put your money in stocks, our safe stocks today, which is the index stock, is not returning this amount. Same goes to other safe assets. So gold has the best average ROI that you can think of in other safe investments. Thank you.
All right, thank you so much, Mr. Peter. Now, there's another question from Joe George. Says, also, as someone who has been mind caught by this lecture that is gaining interest in investing in gold, my question is, when is the best time of the year or the month to invest in gold? Thank you. I'll call Mr. Bamidele to please answer the question.
Okay. Thank you, Noel, for that question. And so, with respect to the best time to buy gold or the worst time, so to say, so it depends on your investment strategy, and that varies from person to person. So if your strategy is to buy gold from time to time, then the dollar cost averaging may be a good strategy, where you don't really mind the price of gold, you just keep buying. The price of gold also moves. It fluctuates on a daily basis. In fact, on the second basis, which refers to the spot price. So averaging your sales out in terms of the time that you buy it may help you yield a better returns, and also help you hedge against the many fluctuations of gold price. And if your strategy is to do sort of one-off investment, and then you will start looking out for when the price is low, and when you can leverage that to buy at the lowest price and get the best value. So It depends on your strategy, so to say. And I think if you understand the dynamics of the gold price, then it also determine how you would, or the best time for you to buy. If you also have a goal to invest on a monthly or on a yearly basis, I would say you don't really need to pay much attention to the price of gold, because historically, based on the charts that have been shown in the earlier presentations, I see that gold has returned an average of 12 to 20% in a 20-year period. And I would say that is a good investment strategy for someone that has also been investing to spread their investment across this 20-year period. One of two, yes, if you bought 20 years ago, then you're looking at an average return of 20% return. So no one would really say come at a loss per se when investing in gold if you look at a long-term view, because basically the point of it is to preserve your wealth, and in addition to that, you also get a good return on your investment. So it depends on you at the best time, and you can also consult with your investment advisor depending on your specific investment goals, and they can advise you better on what time is best for you to invest in gold and how much of investment you need to invest and what type of product also suits the investment goal. I hope that addresses your question.
Thank you, Mr. Bamidele. There's also another question here for you. It says, please talk about gold trading as well.
Okay. So gold trading is simply buying and selling of gold. And it could also be from the perspective of you, the investor, and the perspective of us, the product provider. So you can buy gold, you can sell gold. We can also sell gold to you and buy back from you. So that is what gold trading is. And the gold, in quotes, is investment grade gold, which refer to gold bars and coins of very high purity. And for bars, you would say minimum of 99.5% purity. But we trade gold of 99.99% for the bars. And for the coins, what would satisfy the requirement of investment grade gold would be a minimum of 90% purity of a gold coin, and it must also be recognized as a legal tender in this country of origin. You would, for example, a Royal Canadian minted coin, which is the gold maple leaf coin, carries a face value. The 1 ounce gold coin carries a face value of 50 Canadian dollars. So that has a face value of 50 CAD, but the intrinsic value, which is gold content, is 1 ounce. So the fine gold content of it is 99. Sorry, it's 1 ounce. That's the fine weight of gold in it. So, and the purity is 99.99%, or in finest terms, 99.9. So those are investment grade gold that we trade, and you can also buy or sell back at any time. And buying, as I also mentioned earlier in the last question, also depends on your strategy and your investment goal. So because of that, there are different products that we have at Dukia Gold that are tailored to your specific needs. So if you're an investor that would rather buy a large bar, because buying a large bar would help you save a lot of cost and you get the most value for it, as opposed to buying the smaller quantity, which would be the 1 gram bar. So if you're one investor that wants to invest a large amount of money in gold, and then a 1 kilo bar may be a good option for you. And if you're an investor that wants to sort of create an investment habit or a savings culture in gold, then a pool allocated gold may be a good option for you, because it allows you to invest based on a specific amount. So if you want to set an investment plan for yourself on a weekly or on a monthly basis, or in fact on a yearly basis, if the pool allocated gold offering, you are able to do that because it's flexible and you also be in control of your investment. And we also have the gold coins, and the gold coins may also be suited for you because it comes with the aesthetic feeling of holding a 1 ounce coin, highly recognized, highly liquid, and it also carries a lot of value. So that way you can also keep it for yourself, or gift it to your loved ones, or arrange for the safekeeping of it. And a better option would also be to allow us to arrange the safekeeping for you. And what you don't need to do is pay a nominal fee. and that way, nominal storage fee, and that way you are able to be assured of the safety and the security of your investment. So, and these products can also be delivered to you if you want, or you can leave it in storage, and whichever. It all still depends on what products specifically suit the investment in. So you can also discuss with us. I'm sure contact information have been provided in the chat box. And you can give us a call and let us know what your investment goals are. That we can then recommend the products that best suits your needs based on the products that we offer. So yes, I think that's what gold trading means in short. Thank you, man.
Thank you so much, Mr. Bamidele, and thank you all. One last question just before we conclude. We have one last question. Mr. Olabi Oyebode, we're going to talk to you soon. We're going to address your concerns. But there's a last question from Mr. Charles Leonard, and it says, please talk about the transaction process involved. How long it takes for one transaction, how long it takes for own transactions to be reflected on our portfolio, how long it takes to be reflected on our account as well.
Okay. So I also think the last question that was asked, because it also ties into this. So the question was about what is gold trading. And so the type of gold we traded, the form in which it is traded, or the method in which you trade it is what we refer to as a spot trade. And spot trade means that you pay and there's instant settlement of your holdings. So if you pay us now and your account is credited instantly, you can execute your trade and get the gold in your holdings. So there's instant settlement. So and there is no T+1, T+2, or T+3 like the typical exchange processes. So and the transaction flow is very much straightforward. You can utilize our e-trading platform, or you can also get in touch via email or telephone call. And the first thing you have to do is register, and that would also involve you going through the KYC process. And that's also very important. You need to provide us with an ID. You also need to provide us with a proof of address and other information that will also be requested of you. And once that is done, and typically we verify your KYC within 1 to 3 business days. If everything checks out, we verify. And if we require additional information from you, or we need clarifications of some of the information you provided, we'll also get in touch with you, and we'll just ensure that that is done and verified as soon as possible within the stipulated time frame. So once your KYC has been verified, you get an account number generated for you, and your account is all set up. Then the next thing would then be for you to actually fund your account, which would allow you to make an instant purchase, which is the spot trade. So you need to fund your account through the process we refer to as a deposit request. So you would specify the amount you want to fund your account with, which is also the amount you want to use to make a gold purchase. And once you've done that, you also need to upload the payment receipts. That would also enable us to expedite the confirmation process. And once we verified your payment, your account will also be credited accordingly. And once that has been done, then you can then explore the selection of products that we have available, be it the pool allocated gold, the bars, or the coins. So you select any one. As long as your account is adequately funded to buy that product, then you would have no issue at all buying it. And then once you've selected the product of choice, if it's the bars or coins, you need to add it to cart, select the quantity if you want more than one. And you also need to specify if you want it for delivery or for storage. Either way, your account needs to be funded for you to do that. And if it's the pool allocated gold, you only need to specify the amount and the equivalent weight of gold that would get you would also be shown to you. And we also ask you to recheck and recheck your order before you place it. And then once you've placed your order, and instantly you get the credit of the good amount in your account. So it's instantly. And if you're utilizing our emails or telephone calls, once we've received your funds, your account will be credited as well. Then we'll execute your trade and would send you an email of your trade confirmation alongside details of the transaction, which also gets a document form that will be attached to the email. So you can always be well up to date with your accounts and transactions. And in turn, we would also onboard you on the platform if you are not yet onboarded there. So you can also view your holdings balance and transaction history on the platform as well. So either way, it's easy. Give us a call, send us an email, use our website, and lay hands on it and see how easy it is to actually own gold now and build up on that in the medium to long term. Thank you, Noe.
Thank you so much, Mr. Bamidele. And I will take the final question. Mr. Peter Anirobi would answer this question. It reads, what are the risks involved in gold investment?
Okay, thank you, Noye. It's a very good question because you need to understand that there are always risks associated with everything that we do. And there are some risks we have to understand and we have to consider when making investment in bullion grade gold. So the first thing you have to know is whenever you want to buy a bullion grade gold, there are some questions and there are some tick boxes that need to be checked in order for you to be protected in your investments. Now, what are the kind of questions you need to ask whoever you want to buy your bullion gold product from? Now, the first thing you need to find out from the company is the gold you're buying, do you own it outrightly? Is this gold yours? Or is something that is not allocated to you? Is not your own gold product? Is this gold yours? You need to find that out. Then the next question you need to ask is, this gold that I bought and I'm keeping in your custody, is it stored safely? We have guidelines and standards in the bullion gold industry that guides the storage of gold. And these are standards that are set out by bodies like LBMA and WGC. You need to find out how it is stored safely. Then you also need to find out if you should want your gold today. If you need your gold, can this gold be delivered to you? Now, these 3 key questions you need to ask are what you need to ask about your gold product that you want to buy. They are very, very key. And with us from Dupia, we can assure you that the gold you buy from us are yours. If you want to get it delivered, we deliver it to you. And then if you want us to store it for you, we store it safely. Now, the next question you need to find out is this gold that you're being sold, how is this gold sourced? That is a very, very important question. We might not look at it as very important, but when you talk about investment grade gold, the way you source your gold is very important. For example, remember we said that gold is highly liquid. If you buy an investment grade gold and you take it to maybe Dubai or UK or any other country and you want to quickly change it for cash, and this gold was not sourced ethically, I will tell you that you're not going to get the full value for your money. You've automatically been swindled. So you need to find out, how was this gold sourced? The person who is selling this gold to me, is this person trustworthy? Is this person licensed to sell gold? Does this person adhere to standards? We have standards that guide the bullion gold trading. We have standards from LBMA, WGC, OECD. So you have to find out if in the case whereby this company that is storing my gold, if they should fold tomorrow, what happens to my gold? All these questions are what you need to find out before you can say you want to invest in gold through a company. So you need to ask those questions. And with Dukia Gold, we have you all covered because we source our gold ethically in the right way. We follow the LBMA, the WGC, and the OECD guidelines and standard. And our gold products, the one that we have for you, if you buy a gold and you want to store it for you, are stored in an LBMA standard vault. And what this means is that if anything should happen, you can always take our certificate and get your gold. So this guarantees you that these risks that are involved in gold investment are something that we've looked at and we've mitigated it for you for whenever you invest through our company. Thank you.
And I also think it's important to add product risks to that, because the type of products you're buying is also very important, and there are also risks associated with each type. So if you're looking at the bars or coins, and then the question of full ownership would also arise. So you need to also ask the right questions in terms of, do you actually own the bar or coin in question, or a part owner or a co-owner? And that is very important because the day you come for it, either for delivery or you want to liquidate, and it will also help avoid the issue of
Inside this here, boys, you
question.
need to go take it back to the other side.
I think we have a background. Now you can mute. Yeah. So, and for the pool allocated gold, it's also important to really understand what pool allocated gold is. It's pool allocated gold is a fractional ownership in a large gold bar, typically a 1 kg gold bar. So what that means in essence is that you are a co-owner or a fractional owner of a large gold bar. And when it comes to redemption, you can redeem in 2 ways. The first way would be to actually sell it and get it cash back into your account. Or secondly is to redeem it for an actual gold bar or a gold coin. So because you're a part owner of a large gold bar, and realistically it can't be cut out for you out of the gold bar, another bar or coin will need to be minted to the equivalent of what you already own fraction wise. So if you own a 12 gram pool allocated gold, because typically we don't have a 12-gram gold bar, and so you would need to either redeem into a 10 grams gold bar and perhaps liquidate for cash the remainder, or you redeem into a 10 grams gold bar and a 2 grams gold bar, which you'd also find in the market today. So either way, you need to understand the risks that are associated with different products, and that's important for the day you want to liquidate your holdings, medium or long term. I think that is important to add to that. Thank you, Peter and
Thank you so much, Mr. Bamidele. One last question on the chat box. It says, how much is gold coin today? So I'm going to tell you that gold coin today, 1 ounce Canadian maple leaf coin on our website at the moment is 2.2 million naira. But you can also visit our website. Our website is dukiapreciousmetals.co for more information. And I think we have taken our last question for the day for this event. Thank you all for your engaging questions, and thank you to our speakers for their insightful responses. But before we conclude today's event, I would like to invite again Mr. Bamidele, the team lead of the Precious Metals Trading Unit here at Dukia Gold, for his closing remarks and to also provide us some key takeaways from today's enlightening session. So thank you, Mr. Bamidele.
Okay. Thank you, Noe. I think it's been a very insightful and engaging session, and I must also thank everyone present today for the quality of questions and feedbacks that we've had, and I hope we've been able to address all the questions that we asked. And secondly, if there are any questions or additional questions or clarifications you may need, please get in touch with us, and any of our sales officers would happily address those questions for you. And I think what we've talked about today is very important, because the crux of today's topic is one of the many benefits of gold, which is the diversification part of it. Gold in itself has many other benefits. It helps you to preserve wealth. That's, I think, the number one and the most major benefits anyone would get in gold. It helps you to preserve your wealth. And secondly, it helps you also hedge against inflation. Inflation dynamics, it's a very interesting topic in every country of the world today. And if Nigeria, be it Nigeria or anywhere else in the world, there are inflation issues. And every country or the central bank of the country are doing their best to help curtail the inflation effect. And recently in Nigeria, we also see a rise in inflation, recently at 24.03%. And that is even higher than what economists and experts have predicted. And so if you had actually owned gold as far back as, say, a year or 2 years back, and today you would have, you'll be very happy with yourself because you've hedged against inflation, which is one of the benefits of gold. And thirdly, is the diversification part of it, the diversification benefit that gold brings into your larger investment portfolio. That is why the topic today is looking beyond the traditional asset classes, which everyone typically invest in, and start looking at gold as an alternative investment asset class to help complement your larger investment portfolio, and also help you hedge against the risk and balances and your return out. So one of the reasons why gold is a good diversification tool is because if you look at the returns relative to other asset classes, gold has also fairly performed well over medium to long-term period. And in terms of risk, stocks, bonds typically react to the same set of market conditions, and gold don't react to it, because once we have, say, a market downturn or the economy is not doing well, gold would also either remain stable in terms of price or also perform well, because most people will start turning into gold. And when the economy is good, gold will also perform well, because when the economy is good, there will be more demand for gold. If jewelers will want to buy gold to make more jewelries, electronics industry will also want to buy gold for the electronics, and investors, central banks, large institutions will also want to buy gold. So there will be high demand for gold when the economy is good. When the economy is bad as well, there's high demand for gold. So gold, it's a very essential asset to have in anyone's portfolio. And when there are geopolitical issues, when there are uncertainties, people also turn to gold. So gold is important to have in any portfolio because of that. And lastly, gold is liquid. You can transfer gold. Gold is flexible. Gold is also internationally recognized because it's a form of currency, just that it doesn't have a counterparty risk, which also makes it more valuable than any currency. So overall, I think today we've been able to get the point across, which is that for you to consider adding gold to your investment portfolio to help you diversify it against the risks that come with the other traditional asset classes. And now also our takeaway would also be for you to register today, visit our website, register, and do your KYC and start buying gold. If you have questions, concerns, or you need more information, you can also get in touch with any of the numbers that are provided on the screen, or send us an email. You can also schedule a one-on-one meet with us. We'll be available either physically, colleagues you need us to talk to. We'll also be happy to provide that. And so the point is to deepen the adoption of investment grade gold in Nigeria, because we live in uncertain times. We don't know what tomorrow holds, and one of the ways to cushion against this is to invest in gold. So once again, I want to thank everyone for taking the time out to listen to us today. And this is a session that we hold on a weekly and bi-weekly basis. So anytime we send you an invite, please also share with your friends and colleagues And she also I also say you should also try and join yourself and listen to us. Also read more in your personal time, read more about gold, be informed as an investor. And I think that is very important for everyone. So thank you everyone, and we hope to see you in the next one. You have a blessed day. Bye everyone. And thank you, Noel.